Hello friends. Friends, we are going to continue with debentures, right? So we have discussed about what are debentures. Debentures are the loan taken from public, and on that loan we will pay interest to the public, right? Then we discussed about the disclosure in the balance sheet either as long term debentures or the short term debentures. Clear? Then we discussed about the issue of debentures. That was exactly similar to what we studied in issue of shares. The only thing that was different was the issue of debentures can be at discount also. That is to be taken to a separate account that is known as discount on debentures account. And this discount is to be written off within the life of debentures, right? And it can be written off from the statement of profit and loss or from securities premium reserve account, right? This is what we have discussed. Then there was a case issue of debentures for consideration other than cash. That topic I will not touch, right, because we have discussed the same topic in case of shares, right? So I'll not be wasting time on that topic. So we'll move on to a new topic now. In this lecture, what we are going to do is a new topic, that is issue of debentures as collateral security, right? This is not a very big topic, very small topic, very easy topic, right? Just try to understand. Now here the first question before us is, what is a collateral security, right? So that is the first question. And why we are issuing the debentures as collateral security? What will be the accounting treatment if we are issuing debentures as collateral security, right? Now listen to it very carefully. What is collateral security? Why we issue collateral security, right? You have taken a loan from bank. Loan from bank, right? Now when you take a loan from the bank is always at a risk that whether you will pay back the loan or not, isn't it? Suppose you are giving 1000 rupees to your friend, there will always be one thing in your mind, that whether he will return or not, isn't it? This is a very simple logic. Similarly, the bank is always at a risk that whether the person to whom the loan is being given will return the loan amount or not, right? For that, what they do is they will always keep an asset of that person as a security to cover the loan, right? What they say, a company took a loan from the bank and kept its land as security. Keep its land as security. What they say, that in case the party is not able to repay the loan amount, what will be the bank doing? Bank will sell the land of that party and recover its loan amount. Simple. That is why land is being kept as security, that in case the company fails to repay the loan to the bank, then the bank can sell its land, right? The bank can sell the land of the company and recover their loan amount. Clear? Now sometimes what happens is the bank asks for another security. Besides this security, they ask that even if the land is not able to repay the loan, then they ask for additional security, right? They ask for one parallel security to land. In this case, that parallel security, parallel or extra security, right? This parallel or extra security that the bank is asking besides land as security is known as collateral security. Because when the land is being kept as the security, the bank is at a risk that tomorrow if the value of land decreases, then the bank might not be able to recover its loan from the sale of land. So they want additional security. That additional extra parallel security is known as collateral security. Clear? So what the company is doing, company issues debentures as collateral security. Right? Company says, take our debentures. In case we fail to pay the loan amount, you become our debenture holders. Very simple. Right? Clear this much? So what the company is doing? Company is giving the debentures as an extra security, as a parallel security, as a collateral security to the bank in addition to the first security that might be land, that might be plant and machinery or anything else. Clear? The meaning of collateral security is clear? Okay, let's move on. Now, the company has issued debentures as collateral security. What will be the accounting treatment now? That is important. So accounting treatment can be in two ways. The first way is no journal entry is passed. No journal entry is passed, right? Only disclosure in balance sheet is done. So this is the first method where no journal entry is passed. What you do, you only disclose it in the balance sheet that we have issued debentures as collateral security. Now how you are going to show this in the balance sheet is important, right? In the balance sheet, you have equity and liabilities. If it is a long-term borrowing, where you will show that long-term borrowing, non-current liabilities, isn't it? This is what we discussed in the initial lecture. Under the non-current liabilities, I will show it as long-term borrowing. Now this long-term borrowing I will show in notes to accounts. Right? There I will say long-term borrowing. Suppose you have taken a loan of 5 lakh from bank. So what you will write? Loan from bank 5 lakh. Then what about the debentures that have been issued as collateral security? Those debentures will be just disclosed in the balance sheet in notes to accounts. Here you will say secured by issue of say 6,000 10% debentures of rupees 100 each as collateral security. Clear? So this is how you are going to disclose it in the balance sheet if you are following method 1, where no journal entry is to be passed. What you have to do, you have to just make a disclosure in the balance sheet in the notes to accounts under the head long-term borrowing, where you say you have taken a loan from bank of 5 lakhs, and then in the bracket you will say this loan from bank is secured by issue of this much debentures of the face value as collateral security. So this is how you have to make a disclosure in the balance sheet. Clear? So in the long term borrowing, you will just enter 5 lakh. Clear? So this was method 1, where no journal entry is passed, only the disclosure in the balance sheet is made. That's it. Right? This is a very simple case. The only thing you need to understand is where to show that disclosure. Right? Now, second part is where journal entry is made. Right? Where journal entry is made for issue of debentures as collateral security. Now, what is the journal entry in this case? The journal entry is you will debit one fictitious account known as debenture suspense account debit to say 10% debenture account. Right, by the amount of debentures. Clear? So this is how you are going to show in case the journal entry is to be made. This is the journal entry that you have to make. That is debenture suspense account debit to 10% debentures. Clear? Now how to disclose this in the balance sheet? Let us see. Again, in the balance sheet, you will have equity and liabilities. Right? Under equity and liabilities, if it is long term, you will have non-current liabilities, and if it is short term, you will have current liabilities. Right? In this, you will show long term borrowing. Now for this long term borrowing, we will prepare notes to accounts. Right? In the notes to accounts, what you will have? Long term borrowing. Right? In the long term borrowing, first you will show loan from bank. That is 5 lakh rupees. Now how to disclose the issue of debentures as collateral security? What you will do is say 6,000 10% debentures of rupees 100 each issued as collateral security. So how much it is? 6 lakh rupees. Right? And what you do, you subtract the debenture suspense account from this. Debenture suspense account. 6 lakh. Right? So what is the net effect? Net effect in the long term borrowings is 5 lakh. Clear? So in case the journal entry is passed, this is how you are going to show the debentures. You will show the debentures and you will subtract the debenture suspense from the debentures that have been issued. Right? And the net effect will be the loan that is being taken from the bank, and simultaneously you have showed the number of debentures that have been issued as collateral security. Clear, friends? So disclosure in both the cases, in method 1 where no journal entry is to be passed, and method 2 where the journal entry is passed, the journal entry will be debenture suspense account debit to 10% debentures. Now an interesting part here is when the loan is repaid, what to do? When loan is repaid, right? In method 1, you have to do nothing because you haven't done anything from the accounting point of view. You have just made a disclosure in the balance sheet. That's it. You haven't recorded any entry in this case. And in case of method 2, what you are going to do is you are going to close the fictitious account that you opened at this stage, debenture suspense account. You have to close this account now. So what will be? It will be the reverse entry you will pass. You will cancel the debentures also because there is no need of debentures. To debenture suspense account. Right? So you will close the debenture suspense account also, and you will also close the debentures account because there is no need of those debentures now. Loan has been repaid, right? There is no default, so cancel the debentures and cancel the fictitious account, that is debenture suspense account, which was opened for the purpose of issue of debentures as collateral security. Clear? Now, the next point here is if there is a default on the repayment of loan. If there is default on repayment of loan, then what to do? In this case, if there is a default on the repayment of loan and the bank is going to use your collateral security, right, to meet their loan amount, then what will be the entries? First of all, you will cancel the debenture suspense account, right? Always remember this, you have to cancel this fictitious account. For that, you will pass the reverse entry to debenture suspense account. So this is a common entry in both the cases, right? Now, when the bank accepts your debentures, when the bank is going to use your debentures against the repayment of loan account, then what will be your journal entry? Your journal entry will be like this. First, you will debit the loan account debit, that is the principal amount outstanding. Principal amount outstanding. Clear? Because it is our expense. Then outstanding interest account debit with the amount of interest outstanding. Now you are issuing debentures to 10%. Debentures account, say this is 1, this is 2. So here you will have 1 plus 2. So whatever amount is outstanding, for that outstanding amount you are issuing the debentures. So the journal entry will be loan account debit, outstanding interest account debit to 10% debentures account. Debentures are issued, credited, loan and outstanding interest are debited because these reflect our expense that we have to pay. Clear? So in case there is a default on the repayment of loan, the first step should be the cancellation of the debenture suspense account by passing a reverse entry to what we have passed at the time of taking the loan, right? So you will pass a reverse entry, then you will book your expense loan account debit, outstanding interest account debit to 10% debentures account. Clear? Is this clear, friends? So this is all about issue of debentures as collateral security. Right? I hope this much is clear to you. It was a very small, very easy topic, right? So this debentures is nothing, very easy, right? Default on repayment of loan, that is done, right? So friends, if you have any queries, just send me an email at ksjteaching@gmail.com. right? So what we are going to do in the next lecture is quite important. That is various cases from redemption point of view. Now you might say that, sir, why we are going to do this topic in the issue of debentures when we have redemption of debentures as a separate chapter? We have redemption of debentures itself as a separate chapter. Then what is the importance of studying this topic here? I'll tell you in the next class that why we are going to study this redemption topic at the time of issue of debentures. What is the relevance of this topic when we are studying about issue of debentures, right? So that's all for this lecture, friends. Thank you so much.